there's a lot of research shops, especially sort of sell side research shops that are publishing constantly the CTA positioning, and a lot of investors use this, especially macro investors use this, the relative positioning CTAs, some of the COT reports, that sort of stuff, to feed into their looser models on, how to position in markets. So why is this a thing? Why are investors in general interested in this?
Well, I think there's a number of them. A number of strategies out there, I think strategies is fair, that have grown in assets so much so relative to the rest of the market that their trading can actually be an influence on what's going on. And the three that I think get the most press, the most market analysis on are systematic option sellers. So vol premium harvesting, variance risk premium harvesting, whether it's via variance or short dated optionality selling. And essentially that leads its way into market makers who run equity derivatives desks, and they're buying low and selling high. And depending on the supply of the options out there, there's either a lot to buy on the way down and sell on the way up, or it can actually go the other way. So that's one topic. Volatility target funds, particularly the ones embedded in variable annuities, where I've got a leverage number to the S&P that's moving based on realized volatility. And as volatility goes up, they delever. As volatility goes down, they re-lever back up. That's the second one. And then the third one are the trend following CTAs and specifically. And very often you'll see the research shops have this combination of all three of these together, and their take on what's out there now. How is it affecting markets? How much is long? How much needs to be purchased on a 1% decline? And it's relevant. I think that the sizes of these flows are big enough that if I'm not deep into the strategies behind them, I probably want to know. So I get the reason why, and I actually think it's probably some value add to have it out there and for the research. I just think it needs to be done correctly. Was my point.
Yeah, no, and I agree. And so the way people may trade around this information is, for example, markets peak, for example, when there's no one left to buy, right? Mm-hmm. So when, the CTA is often perceived, I think, by macro traders as a marginal buyer, and it's a fairly predictable marginal buyer if you've got the right tools to predict. And if you can tell when CTAs as an important marginal active trader in markets are maximally positioned. In other words, there's no more dollars from CTAs going in a particular direction, right, into a specific beta or market sector, et cetera. That could be an indicator that we may be near a shorter term peak, right? And so how do these research shops typically model CTA positioning, and what are some of the issues that you found with their models?
Sure. So my biggest issue is many of them do it through a rolling window of a very vanilla linear regression, meaning I've got a benchmark, and in my paper I use the SG trend index, which follows a number of the larger trend following CTAs and follows their returns. So they use that as their independent variable. They use the S&P as their dependent variable, figure out the beta of one to the other over time, use a rolling window of, call it 3 months, six months, 1 month, whatever it is, and just kind of blindly use the outputs of the regression for, okay, here's where the exposure is at the moment.
Okay, yeah. And so, one of the major challenges, of course, is that CTA positioning definitionally changes through time, right? It's non-stationary. Exactly. And so it's a non-trivial question of how to create linear regression models where the betas change through time. Yes. And so I guess this is what we identify as a major challenge in these models. And I think your analysis, and we'll dig into a little bit later, the extent to which it's true, but your analysis shows that they often get it quite wrong at the wrong times. And therefore these reports that use these methods are not of much practical use, right?
Yeah, and again, I don't mean to criticize factor models in general, and for certain investment managers where the reporting periods are sparse or we don't really know much about the underlying process, it may be the best you can do, albeit with lag. And so, if that's the case, it may be a valid way to measure exposures, but you do need to be cognizant of the lag you're going to have as positions can flip long, short very quickly. And if you're running a model, looking at the past returns over, let's call it, 20 weeks, you may need another 10 weeks or 15 weeks before you really pick up that change.
Yeah, exactly. And there's a few firms out there. I know Markov Process has a method that they use to try to map the non-stationary betas to different funds. And so that's interesting. But I have to say that I am much more aligned with the way that you've approached it. I think this is certainly closer to how we approach the problem as well. So why don't you go ahead and take us through it?
Sure. So the funny thing is the history behind this is after seeing, some of the research on this and saying, all right, we know how CTAs trade in general. Do I know how any specific one trades? No, but in aggregate, we know they're a buyer of strength, they're a seller of weakness. They are likely going to ensemble over a number of periods in terms of their trend speeds. They're likely to ensemble across a number of markets. And knowing that, can we do a little bit better in terms of not fitting their returns, but replicating them? Meaning, I'm a CTA. How would I do this? How do I think I would set up my signals? And again, if I'm not trying to maximize the performance, I'm trying to maximize the replication to the CTA benchmarks. I want to do my best to predict how they're going to trade and how their returns are going to trade. And so I took, literally, as I mentioned, this was a 2-hour just fun, research project. And I started with a couple of very simple momentum models, volatility adjusting each market. I picked, by definition, to keep things very tight, I only picked 16 markets. So 4 specific markets across 4 asset classes, that being equities, interest rates, foreign exchange, and commodities. I then applied sort of what I guess we would call a naive risk parity, so inverse volatility weighted signals to each of the markets. I did include a trend intensity a level with a little bit of a parameter, and where I mean by that was if a momentum turned from negative to positive, I used a level of positioning that was based on the intensity, meaning that a flip from 0 to 0.0001 didn't necessarily create that much of a position. A flip from 0 to positive 1 in a sort of normalized space created a bigger position, and as that momentum increased, the position would get bigger. And I put all this together, came up with the results of what I thought my replication return stream would look like. I compared it against the SG trend index, and I got a correlation that was way higher than I thought was possible. So I scrapped it. I said, all right, hold on, I must have done something wrong. Let me do it all again from scratch. Went through it again, same result. Okay, so now this went from just a fun project to let's put a little bit more rigor in this. Let's think about how we can make sure that I'm not just getting lucky. Let's see if we can figure out which momentum feedback or which momentum lookbacks these CTAs are most using, and then from there create a robust replication model.
So essentially, just sort of going through your paper, right? You've got 5 momentum lookbacks. You've got, how many caps did you test? Did you just
5 different caps.
5 different caps.
And think of that for those as almost like a Z-score.
Yeah, so I was going to dig in. So the Z-score is it just the standardized returns? So in other words, the Z-score of the Sharpe ratio?
Yeah.
Okay, perfect. And so there's 5 different caps, which presumably range between 0 and 3 or something.
Yeah, 0 and 2.
In increment 0 and 2. And 5 different look-back parameters for the estimation of volatility.
Mm-hmm.
And so really what you did, if I understand, is you created 125 different strategies, right? Just like potential trend following strategies on those markets based on every combination of those 3 dimensions of parameterization with 5 parameters each, right?
Correct.
And then you found the combination that had the greatest explanatory power on the SG trend index.
Yeah, although just what I first wanted to figure out is, of those 3 parameters, if you will, the look back, the position cap, the sort of Z-score position cap, and the volatility, which of those were most important? And so the first and probably the most interesting graph is taking the R squareds, so the coefficient determinations between my replication and the SG trend index, and sorting them high to low and looking for breakpoints. And the first thing we see very easily is that, and again, using the lookbacks, there's a 4-week, 8-week, 16-week, 32-week, and 52-week. The 4-week look back, a very, very super short term, 1 month, has very little predictive power. Not really a surprise. The 8-week, a little bit better, but still pretty far away. The 16, 32, and 52 were certainly the next leg up. And while the 32-week had a little bit better predictive power than the 16 or 52 on average, they were more or less a plateau that were well above the 4-week and the 8-week look backs. Again, we're talking about the momentum side. The position caps, not so important. The volatility look backs, not so important. Again, there were some peaks here and there that were a little bit preferable to others, but certainly far and away, and not terribly surprising, was that the length of the momentum look back was the most important factor of achieving high replication.
So you did identify that the look back parameter was by far the most important or most explanatory variable in your model, right?
Yes, for sure. And that being the 16-week, the 32-week, and the 52-week. So an intermediate to longer term trend following system, as you would expect.
Yeah. One thing I was wondering is the degree to which, because we know that, or rather our hypothesis, which we've tested at least a little bit, is that the parameterization of trend funds on average has changed over time, right? So how do we think about that in terms of updating your model, or like, I guess, refitting it on an ongoing basis or on a rolling window or something like that?
It's an interesting point, and that is part of the reason I selected only 5 years of data, is that if you went back over 10 years or 20 years where we've got the appropriate benchmarks, you're definitely going to have some less good fits, some not as good fits, because the trend speed, slowed down a little bit over the past 10 to 15 years. Again, as I understand it, and as trend speed has been studied a little bit more in depth over the past 5 years or so.
Yeah, so I can imagine a model where you are sort of running a rolling regression. So you sort of add an extra parameter here, which is a look back window on your model fit. And so, maybe you've got 5 different potential look back horizons on the model fit. So now you go from 125 to whatever, 5 times 125. I should know that. What is it? 625 different models that you're testing now. And it's just like you're adding that model fit horizon just to account for the degree to which the parameters
changes over time. Sure.
Change over time, I think, is great. Yeah. So, okay. So walk us through these charts.
Sure. So we went over the top one on your screen now. That is just the R squared, if you will, from all the 125 models sorted from high to low. So from those, I started to nail down and pick some specific parameters. So that bar chart on the bottom, that is holding 2 of the parameters constant, being a sort of normalized momentum score of 1. Again, think of that as a Z-score, and the volatility look back at 90 days. And you see, and I've scaled the left-hand axis, the y-axis from 0 to 1 in all these, so that they're like for like. You see a pretty big improvement as we go from 4 weeks to 8 weeks to 16 weeks, and then we see the kind of plateau. It looks like 32 is a little bit better than 16 or 52, but again, not so terribly, sharply that we can say for sure it is 32 weeks and not 16 or not 52. And we'll kind of come back to that that later. And then if you've got a chance to scroll to the next page, again, holding two of the parameters constant, again, the 32 in the top graph, it's the 32-week look back is constant. The 90-day volatility look back is constant. And then we look at varying the normalized momentum cap. Hard to tell that there's any difference between there. Again, the peak is at around 1.0, but not
it's
so
not particularly
obvious.
Sensitive to that. Yeah.
No, it's not. And then the bottom, again, holding the look back for the momentum at 32 weeks, holding the cap at 1.0 and varying the volatility look back, same thing. Not terribly sensitive, all things considered.
It's pretty remarkable that 0.01 still continues, like as a maximum threshold,
right?
Still continues to give you signal. I guess if you're normalizing all signals to 0.01, then they end up being somewhat relative. So maybe the magnitude doesn't matter as part of the regression. I need to sort of think through that, but I do think that is interesting. And then obviously the volatility estimation window also has very little sensitivity. So I think that's actually kind of interesting. Did you have any hypothesis going into this on what you'd expect the model to say?
So the look backs kind of as we expected. I mean, certainly I didn't expect to see much on a 4-week. And I guess I am more surprised that there was not a wider variability in the normalized momentum or the volatility look backs. I guess the peak is not terribly surprising. I just thought there would have been more differentiation because these are pretty sparsely, pretty widely varied parameters. And despite the wide variation in them, there doesn't seem to be a whole lot of difference. That probably surprised me.
Yeah, no, that is interesting. So how do you expect investors might make use of this type of model? I mean, I know there's sort of the obvious, just do a better job as a sell side analyst of actually providing information about current CTA positioning, maybe. But then are there systematic ways that investors can incorporate these types of models or build models around this or that are informed by the results of these types of analyses?
Yeah, I think it's tricky to take the outputs specifically, and here's the positioning of CTAs and what's going to happen next. Who knows? If you can tell me the market, which way the market moves, I'll tell you which way they have to trade. I think for me, the more interesting point of view is, okay, if we have an idea of how to replicate these, what happens, and we kind of alluded to this earlier, you did, Adam, when they hit their maximum exposures. What is the return, the conditional return series look like for these CTA benchmarks when they hit their maximum, when they hit their minimum? Is there something to trade off of there? So that to me is kind of the next step of this analysis. The replication part, it's interesting, but I think the true value add is going to be looking at, okay, now that we have a way to summarize how they're trading, what happens when they're at max long, what happens if they're at max short, and does that conditionally affect the returns of the models? And that to me is kind of the next step.